In this video, Canada's Deemed Disposition rules. We're diving into a topic that might sound a little complex, but it's honestly crucial for anyone living in Canada or planning to leave Canada, right? We're talking about Canada's Deemed Disposition rules and what they mean for your taxes. So if you're moving abroad, if you want to leave the Canadian tax system, if you want to plan your estate, or even if you want to convert your home to a rental property, you need to know about deemed disposition. Stick around to understand how it works, when it applies, and most importantly, how it affects your wallet. Quick disclaimer here, this is not tax or legal advice, blah, blah, blah. I'm just a guy with a YouTube channel. Do your own research, book a call with us, link in the description. We have a team of Canadian CPAs that specialize in helping people leave the Canadian tax system. So if you want to work with real expat-focused CPAs, book a link in the description. But let's keep going with the video. Okay, so let's start with the basics. Deemed disposition is a Canadian tax concept. In simple terms, it's when the Canadian Revenue Agency, or CRA, treats your assets as if you've sold them, even if you haven't. The CRA, quote-unquote, deems you've sold them, and any capital gain or loss gets taxed as if there was an actual sale. Okay? So why would the CRA do this? The answer is to make sure Canada collects taxes on gains made on Canadian property, even when you're no longer a resident or when major life changes happen. Here's when deemed disposition typically comes into play, okay? There's a few main situations where these rules kick in. Number one, when you emigrate from Canada, aka when you leave the Canadian tax system. Two, upon death, or three, upon a change in the use of property, if we're talking specifically about property. By the way, for this video, it's not all about your house or your property. The deemed disposition can also apply to stocks and crypto and other assets, but property is obviously a big one for a lot of people. Okay, so of these three main situations, let's break these down one by one. So first, let's talk about emigrating from Canada. That's when you permanently leave the country and become a non-resident for tax purposes. When this happens, the CRA considers most of your assets to be disposed of at fair market value on the date you leave. This does not include everything, though. For example, it usually excludes Canadian real estate, pensions, and RSPs, which remain under Canadian tax rules. But if you own stocks, mutual funds, or other investment assets, deemed disposition applies. Now, here's an important detail for anyone planning to leave Canada. If your total capital gain is above 25,000 Canadian, you can defer paying taxes on those gains until you actually sell the assets. To do this, you'll need to make a deferral election and provide security to the CRA, like a deposit, for the tax that would be owed. If your gains are below 25,000, there's usually no need to go through the deferral process. So keep this in mind. The 25K gain threshold doesn't avoid tax. It just lets you delay it if your gains are above that amount. Because, if you don't actually sell the thing, most people might not have enough cash on hand. So next, let's talk about the second circumstance, which is changing the use of a property. Okay? This applies if, for example, you convert your primary residence into a rental property or vice versa. The CRA sees this as a deemed sale, meaning you'll need to report any capital gains based on the fair market value of the property at the time of conversion. But there is a workaround. You can make an election under Section 45(2), I believe, of the Income Tax Act to avoid this deemed sale if you're converting a principal residence into a rental. This election defers the capital gain until you actually sell the property. Finally, third circumstance, the deemed disposition also comes into play, is upon death, unfortunately. So when a person passes away, the CRA treats most of their property as if it was sold at fair market value on the date of death. This means that any capital gains are calculated and taxed in the deceased's final tax return. However, if assets are transferred to a spouse or common law partner, the tax is usually deferred until they sell the property or pass away themselves. This transfer can make a huge difference in estate planning. Now, some of you might be thinking, isn't there a way to avoid or reduce this tax? Great question. There are a few exemptions and elections that can help. For example, if the property being deemed disposed of is your principal residence, you may qualify for the principal residence exemption. This could reduce or eliminate the capital gains tax, okay? However, keep in mind that only one property can be designated as your principal residence per year, so you have to choose wisely. Basically, that means if you want to leave the Canadian tax system, if you only have, one house, your principal residence, you can do the principal residence exemption, you're good. But if you have multiple properties and you want to leave the Canadian tax system, then it's going to get a little bit more complicated, require a little bit more planning. And don't forget about the deferral elections we talked about, like for immigration and change of property use, okay? And again, we have CPAs that can help you completely optimize this. It's well worth the investment. You can book a call at the link in the description. There's just a small fee to get started and become our client. And then we can really kind of get things moving for you because, by the way, the sooner that you leave the Canadian tax system, the sooner that you can kind of get to a tax-free lifestyle, okay? So sometimes it's better to just rip off the Band-Aid before, the assets keep accumulating in value. Essentially, the earlier you leave the Canadian tax system, the less it's going to sting, right? So to wrap things up, Canada's deemed disposition rules make sure that capital gains are taxed on certain assets, even if there's no actual sale. This can impact you if you're leaving Canada, changing how you use property, or managing an estate. If you're considering any of these big changes, it's smart to plan ahead and know the tax implications. You might also want to talk to a tax professional to make sure that you're taking full advantage of the exemptions and deferral options. I'm sure a lot of people went into this video not even knowing that there were potential deferral options. And this is honestly just the tip of the iceberg. We can go a lot deeper into the strategy than that, okay? So thanks for watching. I hope this breakdown of Canada's deemed disposition rules gave you some useful insights. If you found this video helpful, please give it a thumbs up and don't forget to subscribe to the channel for more content on international taxes, immigration, property laws, escaping Canada, all that good stuff. See you in the next video.